less money for more contributions with a 401k. And 401ks have some additional administrative benefits, some potential liability protection benefits, and also additional tax benefits that they offer, depending on the asset classes that you're investing in.
Whatever the mind can conceive and believe, the mind can achieve.
Welcome to the Dream Big and Think Different podcast, where we inspire, impact, and empower.
Progress is impossible if you always do things the way you have always done things.
It's time to dream big. Here's your host, Dr. Sachin Maskey.
Hello, everyone. Welcome to another episode of Dream Big and Think Different podcast, where our mission is to inspire, impact, and empower millions of people. And I'm your host, Dr. Sachin Maskey, and we have a special topic and a special guest today, Alex Perny, all the way from Florida. And we have a special topic we're going to talk about today: how to invest in real estate with your retirement accounts and other asset class. Welcome, Alex. How are you doing today?
I'm doing very well. Thank you for having me on today. It's always good to be able to bring this type of message to people with educating them on the myriad of options that are available to invest outside of the normal scope of what people think about when it comes to retirement plans. So thanks for having me on today.
Thank you, Alex, and really appreciate your time. And I will just want to disclaimer everyone today that I personally have not met Alex, but I've spoken with him a couple of times, and he has been working in this industry almost a decade now. And I am actually the company, the Advanta Equity. If somebody wants to, somebody's listening to this podcast and somebody who would like to invest with their retirement account, I'll be referring him to the company called Advanta IRA with Alex is working. So before I start, the topic for today definitely going to be talking about retirement accounts, how we can invest with your retirement accounts instead of investing in regular old-fashioned stock market, you can invest in other asset class like real estate, gold, silver, other different asset class that we can talk about. So with that, I would like to start the podcast with first question for Alex. Tell me more about yourself and the company you're at and where you're best at, what you do.
Yeah, absolutely. So I started my career back in the beginning of 2012 in basically right out of college in, the alternative asset space. I've been a finance professional since then, kind of fresh out of college, and always have focused on alternative assets. So anything not on a stock market, a tradable security, bond. I've dealt specifically in real estate, private securities, so startup companies, limited partnerships, private LLCs, and the like. I kind of first got my start in my career of actually doing investments for clients. I was involved in over 1,200 individual actual investments for clients, ranging everything again from buying single family homes to raw land to investing in private startup companies, pre-IPOs, things not like in the United States, internationally. I've bought real estate for clients in Central and South America. I've been involved in European land acquisitions. So I've got to see a lot of really cool and interesting stuff with regard to investing in the alternative realm. And all of this has specifically been done in the context of through retirement plans. So everything I've done has been with clients, IRA monies, Roth IRAs, SEP IRAs, 401ks, defined benefit plans, and the like. So, my expertise is rather, focused, if you will, but it is also broad in a sense of, I'm focused specifically on retirement plans, but the types of investments that I've done and experienced with clients has been, very wide ranging. So I've seen success stories. I've seen, unfortunate, the other side of investing is that, see people, have had failures, and, that kind of really allows me to educate people pretty accurately on, what are, the risks inherent with what you're doing, and also, the available options for you as well.
Sounds awesome. Sounds good. I really, again, appreciate your time. So we're going to dig into more details about all the retirements, pros and cons today. And as you know, the podcast name is Dream Big and Think Different. So this is definitely thinking different out of your box, because I have personally experience in my life and before I started doing other things. And some of the thing I always think about this retirement accounts when I first started working in this country, 401ks, that is the common one in IRAs. So I would like to start with the first topic, like, the first question again. The second question would be to ask you, what is actually a self-directed IRA and what are the types and how it is different from our regular 401k and IRA that the most of the time, is invest in the stock market. So if you like to explain that.
Yeah, absolutely. So I always like to, professionally educate people on the fact that, IRAs inherently, there's a lot of different marketing out there. There's people that say they have some type of special sauce or something like that. It really isn't the case. The IRAs that we do, professionally with the company I work for, Advanta IRA, and their DNA, they're no different than one you could have at Fidelity or Charles Schwab or another self-directed IRA custodian. Self-directed IRAs is basically just a marketing term, and it focuses on the fact that, we allow for people to invest in alternatives. The interesting thing about the IRS tax code is that the IRS really doesn't legislate too much. They do to a point of what you can actually invest in with an IRA. So they put it up to the custodian, be it people like Advanta or Fidelity or Charles Schwab, to say what types of assets they will or won't hold. The IRS basically says you can't buy collectibles, you can't buy a life insurance product or a life insurance policy, and you can't invest directly with certain people. But other than that, the gates are wide open for the custodians to allow what they want. So we focus on basically everything that is not a tradable security. So anything that's not a stock, bond, mutual fund, ETF, those kind of things are what we don't do. And we do basically all the other alternatives. So real estate, private equities, private securities, LLCs, trusts, precious metals, all that kind of stuff is what we handle. So when you hear the term self-directed IRA, it can be a little bit misleading because I do believe the company Fidelity, the large wirehouse, does actually use the term self-directed.
Right.
But again, in the context of what we do, it's just basically marketing to the point that's saying, hey, we allow for alternatives. You as the client can direct your retirement funds in a manner that you see fit without the kind of the overbearing nature of a custodian being like, hey, here's the only things you can buy on our platform. We say, hey, if you, the client, are comfortable with what you're doing, you've evaluated the risk, this is what you would like to do, we will help you process that and do all the IRS back-end compliance to make sure that you're keeping the nature of that tax shelter in place. So things are properly purchased, record kept, expenses are paid, IRS reporting done, all that kind of stuff. So that, in a nutshell, is what a self-directed IRA is. It's an IRA, they're all the same in their DNA, but we allow for those alternative investments to be pursued by the client within that retirement plan.
Okay. So, that's probably, I would say, definition of self-directed IRA, which you explained. But what are the types of the self-directed IRA you can, set up?
Yeah, absolutely. So IRAs kind of come in two basic flavors, pre and post tax. So traditional and Roth IRAs. Your traditional IRA is by far and away the more common type. And the reason is that most people, when they've invested throughout their lifetime, have put money into things like 401ks, 403bs, governmental 457 plans, things like the TSP if you were working for the federal government or the armed services. And most all of this stuff is done pre-tax, meaning you got a tax deduction for putting money into that plan. And when you retire or terminate service with these other types of employers, people will typically not want to pay tax on, $100,000, $200,000, $300,000. So they'll just basically roll it over to a traditional IRA. So that's the most common type, meaning that essentially the way you can look at it is that a traditional IRA, you are paying tax on, or you're paying tax on the fruit of the seed of the tree that you plant. So you don't pay any tax going in, you got a deduction, and when you take the fruit off the tree in your retirement, that's when you're paying taxes. That's the first type, traditional. The second type being Roth, or after tax, meaning that you pay tax on that seed and no tax on the fruit that you pick off that tree in retirement. Those are the two basic types. Now, I will say that traditional IRAs, again, by far and away are the more common type. Roth type plans being less common because people typically want to, save on taxes in the short term. But again, the cost benefit is that what is going to be the present value of money versus inflation versus your current tax rate? Are you going to be better off, when you're earning more money and making more money to be able to pay additional taxes and then being able to reap the rewards of that compounding interest in tax-free distributions in retirement? Personal choice everyone has to make. But those are the two basic types of IRAs out there. Now, I said basic types. You do have things like SEP IRAs, simple IRAs. solo 401ks and all these other interesting types of retirement plans, which I'm sure we'll touch on a little bit later. But again, they all kind of fall into that two categories: is are they pre or post tax, and then you kind of delineate from there.
Okay, so sounds good. So I guess definitely there's a lot to learn today. I'm trying to learn myself here. So I guess the next step would be, I would like to know what would be since we talk about the major difference between the self-directed IRA is to invest in other alternative investment, right? So what are those alternative investment that you can actually when you open up this account and start investing?
Sure. So when it comes to alternatives, basically the broad term is that anything not on a publicly traded market. So the options are really kind of more or less unlimited. I'll tell you kind of some of the things that I've seen to kind of illustrate that. So by far and away, the most of what we see professionally, and this is true with any self-directed custodian. I've been doing this for about 11 years now, so I know plenty of people that work in other companies. And by far and away, what we see the most of is real estate. This is what most people are kind of coming to us for. Is
and that's what we're focusing.
Is real estate in all of its different varieties and flavors. So it's not just buying a single family home. I've seen people buy single family homes and rent them out with their retirement funds. I've seen people do ground up rehab projects. I've seen people be on the debt side where their IRA is actually the lender and holds a secured note and mortgage on a property, and they get principal and interest back. And again, all these kind of play into what the investor's ultimate strategy is. Do you want to be more hands-on? Do you want to be more passive?
Right.
And to that passive point, I know with what you do a lot of is commercial real estate. A lot of people getting really interested, and I think is kind of indicative of the market as a whole on commercial real estate getting more traction, more publicity, and the fact that people understand the benefit of the kind of the input output of investing in commercial real estate. You have much less on the input side for getting much more on the output of how much effort you have to put in to make much more money. You know, you put in a lot of effort to buy one house as opposed to putting in a lot of effort to buy one property that has essentially 80 houses with underneath that umbrella that are all paying rent. So, you know, those are kind of the things that we've seen and kind of the trajectory of the markets that I've seen a lot of. You know, when I started back in 2012, it was everyone trying to buy REO bank-owned properties and fix and flip them. Now it's a lot of just that market has gotten so overinflated and overvalued. I think a lot of people would agree is that people are looking towards the commercial real estate side, whether that's, you know, things like multifamily real estate or things like car washes have gotten really popular. Self-storage is another big market segment in the commercial real estate area that's gotten extremely popular as well. So that's kind of what I'm seeing.
Basically, all the real estate you can think of. What is there any specific real estate you cannot invest with the self-directed IRA?
Basically, just anything that you already personally own. So you can't buy something to or from yourself. You can't self-deal. You also can't buy anything from what's called a disqualified individual. So a mother, father, son, daughter, or spouse are people you can't buy from, or business entities owned or controlled by those people. Past that.
Sorry, can you explain me more about that you just said about that qualified people?
Yeah. So let's say your father owns a piece of real estate. You could not use your IRA to buy that piece of real estate. Conversely, if your father's IRA owned it, you couldn't personally buy it. You know, kind of that dealing within that direct lineal descendant or ascendant of you personally. So look at your family tree, look up and down. Those are the people you can't directly deal with. Or your spouse. Legally married spouse, you can't deal with them. You can partner with those people, and that's maybe a conversation topic for a different time of different creative partnership ways to do things. But those are the people you cannot directly buy any type of asset, not just real estate. So if they had private stock in a company, they couldn't sell you their private stock. And again, there are some shades of gray with different stuff you can do, but in general, that's kind of the ruling.
All right, sounds good. So what are other assets so you can invest besides the real estate? And you mentioned a couple of things. Let's go like a little bit more about those things. I believe cryptocurrency, Bitcoin, all those can be also invest. We can invest with self-directed IRA, correct?
Yeah, cryptocurrency is an interesting one, which you can certainly do, and it's a really big benefit to people, especially if you'd like to invest in cryptocurrency, but it's a knife that really cuts both ways. And it's something that I encourage people to be very cautious with, especially with how hard it is to get money into retirement plans. Cryptocurrency is extremely volatile and extremely risky. And that's probably about as
yes,
probably about as polite as I can say on a podcast of how inherently terrifyingly risky this stuff is. There's big upside, there's huge downside. So with that said, the big benefit of doing that in an IRA is that in 2018, with the big portion of tax law changes under the Trump administration, they changed the way they viewed cryptocurrency. In that, if you're a real estate investor listening to this, you're probably familiar with 1031 exchange, like-kind exchange of real estate assets, where you're not paying tax on any appreciable gain. They're considering it a like-kind exchange. Well, what they did in cryptocurrency prior to 2018 is that, let's say I bought Bitcoin, right, for $10,000, and it went up to 20, and I used that Bitcoin to buy Ethereum. Well, essentially, I had, kind of on paper, made $20,000 worth of profit, but they were considering a like-kind exchange. Well, the IRS said that the utility between these different types of cryptocurrency is so different that you could no longer consider them like-kind exchanges, and you had to start considering them as complete tax lots when you did that. So to kind of simplify that, if you're not familiar with what tax lot accounting is, if I buy something for $10,000 and the value goes up to $20,000, and I use it to purchase something else or exchange for that, I have to account for a $10,000 profit on that exchange. So no longer is it basically just like saying exchanging one thing for another. I have $10,000 of, quote, profit that I have to track for that given year, as if I had sold it, taken my cash, and bought something else. So with the nature of cryptocurrency, with people doing high volumes of trades, having to track those tax lots of profits and losses can get very garrulous doing it personally and cause you big issues in your personal taxation at the end of the year, because anything held 365 days or less is ordinary income. So I know it's kind of a complicated answer to the simple question you asked, but the benefit of doing that in an IRA is that all of those trades, you don't have to track all that. It's all tax exempt. So you could buy Bitcoin, sell Bitcoin, do all this stuff and not have to worry about tracking all these complicated tax lots. So it really brings them a big benefit of doing that type of investing through an IRA. Problem is it's very risky. So yes, you can certainly do cryptocurrency investing through an IRA. It has a humongous tax benefit to the investor, but again, it's very risky. We do it. The weird thing is that we see the interest in cryptocurrency investing kind of tracking directly with cryptocurrency prices. So when the cryptocurrency prices are going up, people are buying more, which is kind of the antithesis of how you want to invest, which is buy low, sell high. So, unfortunately, I see a lot of clients kind of lose value with that. But, if you make smart plays, you do your research, you can definitely see some big benefit to that. Past that, other really popular alternatives besides just real estate are private stock. So people, we see it a lot with banks and people with startup companies looking to raise capital. People will acquire those shares within self-directed IRAs. And you can kind of two-pronged. If you're trying to raise capital, you can get a lot more money from people if you take in retirement plan funds. And if you're trying to invest and see a very good return, that's not going to hammer you with taxes because, again, startup investing can be very risky, but the reward, you could see a 10, 5, 10, 12x on your money, and not having to pay any tax on that is very beneficial. And you've seen people, kind of do that, look at the people like Mitt Romney that have invested in private stock with IRAs that disclose hundreds of millions of dollars in self-directed accounts. That kind of stuff can be very lucrative, very risky.
Yeah. So again, just to let the listener knows that we're not giving any financial or investment advice here. We're just talking about different investment you can do with the IRA. And I would advise you to consult with your professional tax advisor, legal advisor to do any investment. And we know that investment does have risk, and you definitely want to consult your professional. But thank you for sharing that, Alex. And I wanted to, my next question was, besides the crypto, real estate, you mentioned about the private stocks, you mentioned about startups. I think hedge fund and other, like if you want to buy precious metal, gold, silver, you can also do with a self-directed IRA. Is that correct?
Yeah, absolutely. So there's different securitized products on the stock exchanges that you can buy that are kind of, quote, backed by gold or precious metals in general. The problem with that is that you're buying a financial product. You're not buying the tangible asset, if you will. The cool thing with self-directed IRAs is that if you'd like to buy, again, that tangible asset, you can buy a physical piece of gold or silver, so long as they meet minimum fineness requirements, meaning they're X amount of purity. Basically, what I tell people is that if you're buying coins minted by a government, so the United States, Canada, Mexico, China, Australia, Great Britain, Switzerland, you'll be fine. They meet those general requirements.
Okay.
And you can buy essentially gold, silver, platinum, or palladium are the allowable investment grade metals you can buy with an IRA. And yeah, you actually buy the physical metal, the physical coin. You have to have it stored at a qualified storage facility. You can't personally hold it. There were some recent tax law cases that really hammered some people that tried to self-storage stuff. So there's definitely a right and a wrong way to do it, but you can absolutely buy precious metals.
All right, sounds good. So the reason I'm talking about this alternate asset, because just to let you know, the major difference between the traditional 401k and IRA and the self-directed IRA is you can invest in other asset class. We're just talking about real estate, crypto, other private lending, and gold, silver. And guess what? All those investment that I personally have done as a LP and GP, both ways, I found the rate of returns is definitely beats the stock market, and also the volatility of the stock market. You don't get those on the market going up and down with the stock market. I think the best part is you can definitely use your control. Basically, the control is the most important part in your retirement account. That I wanna address that today's podcast. So my first question I want to ask my investors, what is the minimum amount to invest in this kind of investment in our offerings? And when I say 50,000, 100,000, and a lot of time they say I don't have money in my bank, and then I tell them, hey, do you have a retirement account? And then when I tell them, you can actually invest in our offering or other asset class with your retirement account, and this is one of the way to invest with your retirement account. So it's very good information. So I guess another quick question about so let's say there's always a catch, right? Why you said that marketing self-directed IRA, why this is different, but is there anything that I need to be aware, myself and the listener, to set up this account, something called Self-directed IRA with Advanta IRA? What are the steps involved? What are the fees involved? And how this is different from other custodian you guys are?
Yeah, sure. I mean, not to get too salesy. It's kind of a a hard topic to answer with being kind of objective with it. But it shouldn't very general, because no one wants to sit and listen to a sales pitch. I mean, the general difference between us and other custodians, we kind of focus on, the service to be able to buy real estate or buy a private security. I'm not going to sit here and say that we can do any specific type of investment one of our competitors can do. That's not the case.
Okay.
You can, just like with, you can buy Microsoft stock at Fidelity, you can buy it at Charles Schwab. Same kind of difference in us and our competitors. We try to focus on customer service.
Okay.
That's really the only differentiator that we're going to really have to do. Fees can only be, you can only go so low without sacrificing the ability to pay employees to have good customer service. You got to have cost savings somewhere. So we're certainly not the cheapest out there, but we're by no means the most expensive. We try to keep our fees very competitive. We constantly look at what our other competitors are charging. But essentially, again, customer service, we have dedicated account management for any client that comes in. So you don't have to have $1 million IRA to have a single point of contact. That's what we like to focus on. But past that, again, fees being what they are, again, try to keep them very competitive, but the basic way that you pay for this kind of service, because, we're not selling the investment like, Charles Schwab or Fidelity. They're making their spread on the bid ask of trading on their platforms and kind of at the more micro level. So you might not see a fee at somewhere like that if you're just a house account, but they're making money. They're not a charity. They're making money on you trading on that platform. I guarantee that.
Mm-hmm.
The way we do it, we either charge for the number of assets you have under administration or the value of the account. And then, if you do a transaction, we charge a fee for reviewing stuff and processing it. We don't charge commissions. If you hit a home run, we're not going to charge you, a scaling fee saying, hey, you made 10 grand on this investment. Our commission is, 1.5%. It's, you make what you make. It's really easy to calculate cost basis. And I always encourage people, every single thing we do is different. Contact us. We can kind of review exactly what your fees would look like, but they're always going to be very nominal. If you do one investment with us, you're looking probably paying about $400 the first year and about $300 in record keeping fees the subsequent years that you hold it. So, it maybe certainly isn't geared towards someone just trying to do, a $10,000 investment. We definitely don't see as many of those kind of clients. We certainly have them. But, if you're dealing with $100,000, $200,000, which is what most people's retirement plans is by the time they start doing self-direction, I mean, the cost basis is extremely low.
You're listening to the Dream Big and Think Different podcast with Dr. Sachin Maskey. Be sure to stop by SachinMaskeyMD.com to download a free copy of Dr. Maskey's book.
So, I mean, there is some fees, looks like the first setup fees. And I think there's something called setting up the LLC when you do some with other custodian. Do you guys also charge some fees for setting up the LLCs?
So you don't have to have an LLC. And that's one of the things I kind of, just, I never like to talk bad about anyone else in our industry, but it's just a little bit of a frustration point, is the lack of kind of consistent information. So what you asked about, a lot of people like the marketing term in general is what's called a checkbook control LLC, a checkbook control IRA, where someone will set up an LLC that the IRA would own. So the IRA becomes a shareholder of an LLC, and then the client, as the manager of the LLC, can write the checks and direct all the investments under that LLC. Now that has a few advantages and definitely some disadvantages. So to the point of, do we do that for our clients? No, we don't do any legal document drafting. We do not require that you go through that kind of structure, which again can be, a cost savings to the client. And also, I like to educate people on the options to do what you want to do. Here's a good example. So a client that wants to invest in things like, let's say, tax deeds or property auctions, having that tight control to where they don't have to contact us to interface with someone. They can set up their LLC interface. The IRA is plugged into the LLC. They can buy things at auction. They can do that kind of stuff when they want to, when they need to, without involving us. Definitely a big benefit. But I had a client that wanted to buy a townhome in a 55 plus community, had a long-term tenant installed, had property management that took care of everything. And she wanted to do it through an LLC. Well, I told her, I was like, look, you're going to pay a couple $100 to have that LLC set up. You're also going to pay the state that you registered in, between $100 to $200 a year just for the annual registration of that. You're also going to have to make sure that you're abiding by the terms of that operating agreement, keeping that current. So that way you don't have the LLC fall out of favor with the state. So there's a lot of overhead for when you don't really need that. And that's, again, there's a lot of marketing to push people towards that structure, especially if you're investing in like limited partnerships or private stock or private loans, and you don't need the ability to write checks and stuff. It's more expense that you're not going to recoup and just more overhead that I don't really think you need. But if clients want to go that route, they feel more comfortable having total and tight control with an LLC, I am happy to help them with it. But it does increase your cost, and it does increase your administrative overhead of something you're responsible for. So again, kind of a long way to answer the simple question, but I think it bears a little bit of additional context because there is so much promotion behind that IRA LLC structure that I think, again, it always needs a little bit more context because it's so marketing driven in that particular vein.
Yeah, I think I agree with that because everyone is different. Everyone's situation is different. Everyone works differently. So I think definitely there's a separate discussion, but I just want to touch base with that because a lot of time when I talk to company like custodian IRA, they do mention that there's a setup fee for LLCs and and how to set up those. And I think there's a benefit and there's a cons as you mentioned about the cost involved, annual cost and all that for sure.
Yeah.
Let's talk about self-directed again here. Most like IRA rules and regulation, meaning like what are the prohibited transaction that you already mentioned a couple of them, and how like the practical question like contribution, how much you can do and in each type. So basically we can focus on two main account here today. One is regular self-directed IRA, and we want to go about something called solo 401k. I think we can talk about those two accounts and difference between the contribution limit? Because there's a huge difference on that type of account, and how we gonna roll over the meaning somebody has the previous 401k, which this is very helpful for somebody listening who has a previous 401k from previous employer, and actually those people can roll over their previous 401k to the self-directed IRA and invest on other asset classes that we just mentioned and grow their wealth.
Yeah, absolutely. A lot of questions in there. So
Three
let's kind of
questions.
start from the end and work back. So I think we'll start with the easy ones and the ones that have the more context at the end. If you'd like to self-direct an IRA, it's really very simple. I mean, you just need to, essentially open up the IRA and then, contact someone like me that can help you figure out, hey, how exactly do I roll this stuff over? Which is a little bit different depending on what type of an account you have. If you have an old employer plan, like a 401k, some type of, again, like 403b, 457, something that you participated in with an employer, basically you open the account at the custodian, the self-directed custodian, and direct that other.
So you can
401
open your account yourself, or you need somebody to open an account for you. We need to call you guys to open an account for the first step.
Well, yeah, you call someone like me
Okay.
to open the IRA, and then we would, give you the procedure on how to get the funds extracted from that other plan and rolled over to us. With an IRA, different, like if you have an IRA externally and you want to self-direct it, it's basically a form you complete on our custodial side that we send to them, pull the funds over, you're ready to go. So again, don't want to spend too much time on that. That's pretty easy. To the other point of things like prohibited transactions that you asked about, I like to demystify that a lot because, yeah, the penalties for a prohibited transaction are bad. And there were some legislative updates in the new Secure Act 2.0 that changed a few things about that. Essentially, if you have been deemed to have committed a prohibited transaction and the IRS really wants to nail you for it, they can essentially disqualify that entire IRA as of January 1, in which the year that the transaction occurred. You'd have to take the entire thing as a distribution, refile all of your subsequent tax returns. You probably end up losing about half of your IRA balance in fees and taxes.
Wow.
So it's a really big deal. But again, it's a very scary penalty, but avoiding them's not that hard, which is the nice thing.
You're right.
It's like driving on a mountain road. Yeah, if you go off the side of the road, the consequences are dire, but go slow and just focus on the roadway and you'll be fine. Same kind of thing happens here. So long as you don't, again, deal with people in your direct nuclear family, so up and down from you, you don't deal directly with yourself of buying and selling things to and from yourself. You don't buy anything that's collectible, so artwork, stamps, baseball cards, Pokemon cards, that kind of thing.
Mm-hmm.
You don't buy a life insurance policy directly, you'll probably be fine. So again, I get a lot of those questions about, hey, I'm really concerned about prohibited transactions. Well, you should be, but at the same time, not that hard to kind of avoid those.
Sure. So I think so. What will be for example, any prohibited investment? I think you mentioned briefly, but can you tell people that you cannot invest in certain, like a life insurance you talk about, right?
Yeah, basically, directly buying a life insurance policy is not something you can do. But here's kind of the context of what most people would run into. Most people that are self-directing probably aren't interested in insurance. They're also probably not interested in buying, a Dolly or a Van Gogh in their retirement plan as well, or a bunch of wine that they can't drink. So more to the commonplace would be like, let's say you were the owner of an LLC that invested in real estate, right? Well, the LLC owns the real estate in a technical sense. You don't personally own it. That's part of the legal separation and liability protection with an LLC, is that you're one step removed.
Mm-hmm.
An entity owns. Kind of the same thing with a trust. You don't personally own it, you benefit from it, but the trust of the entity actually owns that property.
Right.
Well, you open up an IRA and you say, great, I have this property that this LLC owns. It'd be a great investment for my IRA. Even if you had that thing appraised at a certified market value and you transacted between your IRA and your entity that you own or control on a fair market value basis, prohibited transaction, clear cut. You cannot do that.
Okay.
The IRS is very clear on that. Conversely, it's a little bit easier to say, hey, if my dad, owned a property and I just directly transact with my father or mother, yeah, that's prohibited as well. Those are the kind of things that people run into. to answer your question in a little bit more of a nuanced sense, again, those are the easy ones, but you asked about precious metals, so I think it might bear explaining. There was just a recent court case, USB McNulty, where, and especially to checkbook control, it kind of ties in a few things. So these clients, husband and wife, had opened up checkbook control IRAs. So they opened up IRAs at a self-directed custodian. It was not Advanta. I won't mention the custodian, but it's public record if you want to look it up. And it really wasn't necessarily the fault of the custodian at all. It was the clients not understanding the rules. So they open up the IRAs. They establish this LLC that the husband's IRA and the wife's IRA 50-50 jointly owned as members. The custodian took in the rollovers, then moved it out to the LLC. So now the clients have direct checkbook control. They went and purchased precious metals. They went and bought all this precious metal. Well, what did they do? They didn't store it at a safekeeping storage facility, because another kind of nuanced part of that rule is you can't have direct, unfettered access to an IRA-owned asset, which when you're dealing with real estate, you can't live in it, can't work on it, that kind of thing's easy to explain. What they did is they had the metal shipped to their house, stored it in a vault in their basement, and then the IRS came to find out about it, took them to court, and then they lost about $500,000 worth of IRA plan assets because they were trying to self-store that asset. So that's another big issue that people run into, is kind of that direct owning and controlling. And I guess maybe to that point, the purchase side of things is easy to understand. The other, again, more nuanced part of prohibited transactions is that once you buy a property with an IRA, you can't work on it, you can't live in it, you can't utilize that property. It has to be investment purposes only. So think about it, even if you bought the house next door to you with your IRA, treat it like it's on the other side of the country. If you're in Florida, pretend that thing's in Seattle.
I like that example.
Yeah, pretend like it is so far away from you that you literally can't do anything. Now, with that said, is it a prohibited transaction to walk through a property if you had someone come replace a water heater and some interior doors? If you're buying single family, absolutely. Go through, check, make sure the work's done. But don't go do that work yourself. Is definitely something I encourage. Now, it's a lot easier to stay, on the right side of the IRS if you're investing in like commercial real estate. Commercial real estate investors, they're, doing it for the passive nature of it. This is kind of the thing that people that are more active real estate investors kind of run into when they're like, hey, you know what? I just need to replace some doorknobs and paint a few walls and patch some drywall. Is the IRS riding around in little cars, inspecting these things on a micro basis? No. But the penalties are such that they want to dissuade you from thinking that's a good idea. So that's kind of where I leave it with the prohibited transaction stuff. How to avoid those.
I really like the examples and really appreciate you giving those good examples. And we are kind of running out of time here, but I just want to touch base on the important topic of contribution. And we can just focus on the difference between solo 401k and the a regular IRA, because there's a huge difference and people
absolutely.
Yeah.
So the two big types of plans that we offer, there's individual plans, which IRAs, individual retirement arrangement, is what IRA stands for. That's the acronym. The other one is we deal a lot with self-employed individuals or people that have some type of self-employment activity, which a lot of real estate investors have some type of self-employment activity. And when you hear the amounts that you can contribute into an IRA on an annual basis, they're not nothing, but when it comes to the price of real estate assets, it takes a while to get there if you have kind of started from scratch. So annual contribution to an IRA, so traditional or Roth, is $6,500 if you're under 50 and a half, $7,500 if you're over the age of 50 and a half, which again...
And this one changes every year, correct?
There is COLA, cost of living adjustments, on an annual basis, and they changed it with the tax law update to have a little bit more of a kind of a real-time tracking of inflation, so that these the amounts you contribute will update a little bit more often, because normally it'd be like every other year they'd bump it up by about $500. So
okay,
they do go up, but it wasn't necessarily kind of fixed on how they did it. Now it is a little bit more, again, more of a live update.
And also it depends on what is your age. Like 50 and above, you can contribute more, correct?
Yeah, you get $1,000 catch-up kicker if you're over 50 and a half. So $6,500 or $7,500 for IRAs. The really cool plans I really, really like, and I think are very powerful for the real estate investor for a multitude of different reasons, are the SEP IRA and the solo 401k. Now, again, these are business type plans. So if you have let's say you work a 9 to 5, but you have an LLC that you own a few rentals through, you could qualify for a business plan with this. And again, this is stuff I teach like whole 2 hour long classes on like the minutia of like
Next
having
next
multiple
episodes,
retirement
we're gonna
plans.
discuss more about it.
Oh, I will love to nerd out on tax law and contribution calculations. That's what I like. I'm the guy that kind of does a lot of that with our company with like reading through actual legislation and contribution stuff. I'm a big fan because again, it's powerful tools.
It is.
The IRS gives you really powerful tools if you just want to read the tax code, which is mind-numbingly boring, but if you do it, you can reap a lot of benefits. So the cool thing is that let's say you even work a 9 to 5. You don't have to be fully self-employed to have a self-employed plan additionally cover you. And you can be covered by multiple retirement plans, i.e. you could be covered by multiple 401ks or multiple SEP IRAs, which is really cool. So let me break down exactly how much more you can contribute to these types of plans than just the $6,500 or $7,500 per year. So let's start with the SEP IRA because it's a little bit easier. Again, this stands for Simplified Employer Pension, SEP IRA. So a SEP IRA is basically an additional component of a traditional IRA, but they did just change some stuff. I won't get too far into that. But again, think about it kind of like a traditional IRA on steroids. You still have your $6,500 or $7,500 contribution depending on your age, but because it's attached to a business, you are able to contribute a percentage of your compensation to that plan additionally. So in 2023, you can contribute up to 25% of your compensation or an additional $66,000 to that plan per year.
Wow.
So when you're looking at that, you can contribute, $66,000 plus $7,500. You can contribute almost $73,500 to that plan on an annual basis if you're over 50 and a half. That's awesome, right? That's a lot more than $7,500. That gets you to a place a lot quicker. And the cool thing is that with the tax law changes, previously SEP IRAs were only tax deductible contribution plans, meaning that you wrote off everything you put in there. So it's tax deferred. One of the really cool things that the Secure Act 2.0 did is it created a Roth SEP IRA. So now you can make direct after-tax contributions into these plans. So instead of having to do all of your contributions pre-tax and then do a conversion, you can do either a mixture of both or contribute the entire thing after tax, essentially creating almost $73,000, again, in a maximal scenario. And it has to be 25% of compensation is the ratio. So you can't say I made $100,000, I'm going to contribute $66,000 because that would be 66% of 100. It has to be 25% of compensation. So it's a scaling thing. Which is one of the really cool differences between SEP IRAs, 401ks and SEP IRAs is the ability to show less income and contribute more money with a 401k. But I digress. So SEP IRAs has some changes. You can either do Roth or traditional now. And again, up into the $70,000 range of total contributions to that plan, either being deductible or not deductible, gives you a lot of flexibility on how you play with your tax liability at the end of the year. And again, you can have a 9 to 5, and if you have some type of self-employed income, or you have, let's say, an LLC that you run some rentals through, you can qualify for these types of plans and take advantage of sheltering that income and plugging away that into a retirement plan, especially if it's, let's say, a secondary income stream that you don't really, quote, need. It's just extra money that you're either going to invest or do something else with. Why not put it into a tax shelter and get all of that additional benefit of growth and tax reduction or tax exemption? Really cool. So with that's the SEP IRA, business type plan, have to have some type of business activity. If you only work a 9 to 5 and come home and cook dinner for the family or play Xbox, unfortunately, you can't really qualify for that. You have to have some type, sell widgets on eBay, invest in some real estate, that kind of thing. Solo 401ks are really cool. They're a little bit more complicated, but with that complexity comes a lot of additional benefit. So SEP IRA is just 25% of compensation is how you calculate your contribution into that. With a 401k, it's a little bit more complicated. So what I would tell people is that with 401ks, think about the one that you're covered with your current employer. Most people out there that are investors or have probably been covered by a 401k at one point or another. You go to your HR department and you say, hey, I want to defer 10% of my compensation into that plan out of every paycheck. They go, thumbs up. Great, we'll do that. So you look at your paycheck and you see, what's called an elective deferral. You elected to defer your compensation into that plan. Now, on a singular basis, the maximum that you can do on an annual basis is $22,500. So if you made, let's say, if you paid yourself $50,000 in self-employed income, you could contribute $22,500 of that to the 401k, either pre or post tax, either write it off on your taxes or don't. Now, if you're under 50, if you're under 50 and a half. If you're over 50 and a half, you get a $7,500 catch-up contribution, which is awesome, as opposed to just that $1,000 you get from an IRA. So you get, the 22.5 plus the 7,500. So you get $30,000 of total deferral that you can make on the front end. And again, that's dollar for dollar compensation deferral. You could pay yourself 35 grand and contribute $30,000 of that into the plan. Again, really cool. So you can make less money and contribute more easier with a 401k. The other part of the 401k where it brings it up basically the same level as the SEP IRA is that when you think about the more traditional employer, you have the match. The way that a match works with a solo 401k is you take your total compensation if you're an S Corp or a self-employed individual, and you can contribute up to 25% of your total earnings, not to exceed $66,000 of total plan contribution if you're under 50 and a half, or $73,500 if you're over 50 and a half. So you have the match you get to take advantage of, which again is a little bit different than when you think of like, hey, in a more traditional sense, you have basically a spread that your total contributions can't exceed. But the 401k is really cool with that, in that, again, you can pay yourself a lot less and contribute a lot more to that plan. So dollar for dollar, if you had $100,000 of total income for a given year, you can contribute about $48,000 in total with a 401k, as opposed to like, let's say like 30 something with a IRA, just with a SEP IRA, just doing quick math in my head. So again, less money for more contributions with a 401k, and 401ks have some additional administrative benefits, some potential liability protection benefits, and also additional tax benefits that they offer depending on the asset classes that you're investing in. So again, I do like whole courses on how cool those things are. But in general, those are the two big employer plans, the SEP IRA and the solo 401k, and how they differ from IRAs in general. They all have their place. I wouldn't say that anyone needs to kind of, break their back to try to fit a square peg in a round hole to get one plan versus the other, unless you have a really specific use case for what you're trying to do. But there's a good fit for everyone. Just because something is better doesn't necessarily mean it's going to do the most good for you. We talked about it yesterday. It's, there's good, better, best. Just because you only can use an IRA doesn't mean that because the 401k is out there, you shouldn't do it. It's a sliding scale, and who's to say that your investment career is not going to take you to where you could qualify for a quote plan that might work better for you. But again, on face value, those are the basic differences, and those much better, higher contribution plans that people typically like to look at.
Yeah, I mean, this is a high level, guys. I mean, there's a lot of digging into solo 401k. There's a lot of requirements, and it's not easy to set up those things. But thank you for the information. We want to end the show by talking 2023, the Act version 2.0. That you can just a couple of changes that was done recently, and then we'll go from there.
Yeah, absolutely. So there were a lot of them, and
that's the major one, a couple of them.
Yeah, the major ones. I've taught. I also have a podcast as well that I did a whole podcast episode dedicated to this. As well. It's the Alternative Investing Advantage podcast. I think it was one I did like 2 weeks ago. It was about an hour of me talking about it. But the high level stuff that I want people to know is that they did some really cool stuff with additional contributions for participants. So starting in 2024, individuals that are 60, 61, and 63 have the ability to contribute an additional $10,000 per year in that age range for those 3 years into traditional or Roth IRAs, which is awesome. So you have the ability over the course of 3 years, if you are a married couple, to get an additional $60,000 into traditional or Roth IRAs in that time span. So it's a great tax benefit, especially those people that don't qualify for solo 401ks, to get more money into these tax shelters. And if you're making under $145,000 per year as a household or an individual, you can contribute to pre or post tax. If you make over that, you have to contribute to a after tax Roth plan. Some additional benefits, the really big one is that with SEP and simple IRAs, where they previously had to be all pre-tax, so tax deductible contributions, now you can make after-tax Roth contributions starting this year, which is another really big one. The required minimum distribution age is being bumped up incrementally over the next 3 years. It's going up to 73, and then in 2025, we'll go up to 75. And then one of my favorites is the penalty for failing to take a required minimum distribution. There's two things with RMDs. So in pre-tax plans and with 401ks, you previously, once you reach the age of 73 or going up to 75, you had to take out a certain amount of money calculated on your life expectancy versus the total plan values. Now, if you failed to take that, which is easy enough to do, tax code's not easy. If you have maybe multiple accounts and didn't calculate them all correctly, and you didn't take the correct amount or any in a given year, this is going to probably blow a lot of people away. The penalty for failing to take an RMD is was half of the amount that you failed to take. So if you had a $100,000 required minimum distribution, you still had to take the $100,000 out and pay taxes on it, but you had to write a check to the IRS for $50,000 of a penalty.
Oh my God.
Yeah, that's wild. It effectively disproportionately penalized people that had less money, poorer people. If the person that has a $100,000 RMD definitely doesn't have it. They have a lot of money. For them, paying $50,000 is a lot easier than the person that, let's say, on a fixed income had a $1,000 RMD. And really needed that whole $1,000 and now has to pay $500 as a penalty. One of those two people can absorb that a lot better than the other, and it's not the person with a $1,000 RMD. So now what they have done is they have reduced.
Sorry,
that
what is RMD? You
required minimum. Required minimum.
Just want to make sure that people understand that.
So now the penalty has been reduced from 50 to 25%, which is a step in the right direction. But what they really improved on is the fact that if you self-report and amend a tax return, the penalty is only 10%. So,
Okay.
Yeah, so they've really kind of realistically adjusted that stuff to where, you know what, this is much more reasonable. If you find out, hey, I made a mistake, and you self-report, they're going to say it's 10%, which I think is very reasonable.
Sure.
And then the other one is that previously the only account type that was exempted from required minimum distributions, and this played a lot into a lot of people's tax planning, were Roth IRAs. The thought being is that required minimum distributions are a way for the government to start collecting taxes on the tax-deferred tax shelters, so traditional IRAs, SEP IRAs, simple IRAs, traditional 401ks that they've never collected tax dollars on. But they had a weird carve-out to where they said Roth 401ks, so after-tax 401k dollars, did have a required minimum distribution. Now they have kind of simplified and unified that portion of the tax code to say any after-tax retirement plan, so that's going to be the new Roth SEP IRAs, the new Roth Simple IRAs, and Roth 401ks have no required minimum distribution. So for older individuals that want to invest in things that are more illiquid, like commercial real estate, rental properties, private securities, that's a really big benefit to being able to have no required minimum distribution when you are, let's say, cash poor and illiquid in an investment structure. So those are the kind of the big things that I really like from it. I read.
So mostly good news.
Yeah, mostly good news. I mean, there's some stuff that's probably going to ruffle some feathers on a few sides. But I think in general, it's going to be a net positive of things that are going to benefit taxpayers. Actually, there one more thing before we end it off. One of the cool things that I think was nice is that one of the issues that is kind of prevalent with people not participating in retirement plans is kind of tied to the rise in higher education and student loan debt. So if someone, let's say, coming straight out of college, and I was a victim of this when I came out and I had student loans, I didn't participate in a 401k because I would have rather paid that 9, 12, 13% debt off than participate in my 401k. I think it was a sound financial decision. I think most people would too. But it also set me back a few years in my retirement planning. I elected to pay that debt, and because of that, I missed out on that matching contribution with my employer, that free money. Well, one really cool thing that they did is they said that if you are paying qualifying student loan debt, and they haven't really clarified what that is, but if you went to probably an accredited university or a trade school and you have student debt, you are paying that, they will consider up to a certain amount that as basically participating in the 401k plan. So if you're participating in a 401k and the employer says, hey, I'll match 4% of your contributions, you put $1,000 in there, they match in a certain amount of your contribution level, or they just say a dollar for dollar to a certain amount. That $500 you paid to the student loans will be treated as $500 as if you had put it into the 401k, and you'll still be able to get that free match that the 401k had. So I think that was a really cool, I'll give credit where credit's due. I'm not a big fan of government and tax code dealings for the most part. I think it's, kind of short-sighted and they don't see a lot of things, but I think that was a good one that, will definitely help people, and it would have helped people like me as well. So again, I think it's going to be a net positive with a lot of this stuff. Some stuff I definitely give big thumbs up. Some stuff I'm kind of neutral. Some stuff, don't like that much.
I think it's all good information, good news. We definitely have to do a webinar session with you and another advisor down the road. I'll maybe have another podcast just to talk about
I would be more than happy to.
401k, and a lot of learning from me today, and really appreciate a lot of it. And as I don't know if you guys know this number, but I think you and I talked yesterday. There's about $34 trillion, T as a Tom, in the retirement accounts altogether. And I guess it's a huge thing to understand. It's a very complicated topic, but I appreciate we have dive into a little high level today. Before we leave, this is the last question I ask everyone. Where the people can reach you, and what is the one thing you want to share today before we leave?
Yeah, absolutely. If anyone wants to reach me, my direct phone number is 727-754-9954. Always give me a call. It's my direct office line, forwards voicemails to my email and my cell phone. It's not a texting number, so it is a landline. So if you text it, it will go into the ether and I will never see it. I can be emailed directly. Yeah, I can be emailed directly at A Perny. That's my last name. So Alpha, Papa, Echo, Romeo, November, Yankee, A Perny at AdvantaIRA.com. I'm always happy to help. I'm really passionate about education and everything. And one thing that I want people to take away from this is that it's never too late to start. And there's always typically a fit for someone out there. Granted, I have dealt with clients that have started with $1,000 IRAs, $2,000 IRAs, and I've dealt with people that have tens of millions of dollars in IRAs. Don't be discouraged from starting. Although that may not always be the best fit to do self-direction, I would always love to have the conversation with people and at least help them find a good fit. That's what I'm really passionate about is, helping people be educated, make sound financial decisions. And whether that's with me or someone else, I just like to make sure that people understand that personal finance can be intimidating. When it comes to thinking about your money and your retirement, it's daunting. And especially when it comes to talking to someone that has, a vested financial interest in you going with them, I got to keep the lights on in my house. My job is to, build more business for Advanta. But I'm really passionate about helping people, and I hope that comes through in, the way that I do these things, with not trying to just say, hey, Advanta's the best company ever, you should come with us, and, everyone else, go by the wayside. I'd like to think that I put that out there. So give me a call. Let me know how I can help you. We'll figure out something that works best and, get you pointed in the right direction.
Yeah, thank you. Thank you for that advice. And I really see that you have a lot of knowledge and a lot of passion and really want to educate people and make the right decision. And taking massive action, guys, is the real way, key to success in anything you do in life. So again, thank you everyone today to listening, and whoever is watching, to give us some love with subscribe the channel and give some 5-star review. We'll be doing more of this. And again, thank you, Alex, for your valuable time today, and we'll keep in touch. And thank you, everyone.
Yeah, thank you, Dr. Maskey. Thank you very much for having me on there. Hope everyone found some information here useful, and have a great day.
Thanks, guys.
Thank you for listening to today's episode of Dream Big and Think Different. We hope you enjoyed it. Please be sure to subscribe to our show so you don't miss any gold nuggets. We would appreciate it if you could rate and leave us a review on iTunes, Spotify, and other platforms. And be sure to stop by SachinMaskeyMD.com to download a free copy of Sachin's book. Until next time.